Welcome to the deep dive. You know, while we don't have a crystal ball for your investments.
If only.
Exactly. But we can take a deep dive into the numbers, the insights, really see if a company like Sirius XM Holdings Inc. could be, a smart bet for your portfolio.
Right. And that's our mission today. We're unpacking Sirius XM, the audio entertainment giant.
Okay.
We're going to dig into their financial filings, those 10K reports from 2020 right through 2024.
And we're mixing that with analyst views.
Yep. Combining that with insights from a pretty recent Morningstar report from July 2025.
So the goal here really is to help you, our listener, answer that big question. Is this a good company to invest in?
Exactly. We'll look at the business itself, who's running it, how they stack up against competitors.
Growth prospects too, right? And the risks, always the risks.
Absolutely critical. So let's dive right into their business model. How does SiriusXM actually work?
Okay, lay it out for us.
Well, fundamentally, you need to see they operate two main sort of complementary audio businesses.
Two sides of the coin.
Kind of. First, there's the core SiriusXM segment. That's the one most people think of.
Satellite radio.
Primarily, yeah. Subscription-based in the U.S., offering, just a huge range of stuff. Music, sports, comedy, talk, news, weather, podcasts, infotainment, too.
And how do people get it? Still the satellite dish thing.
It's distributed through their own satellite systems, yeah, but also streamed via apps, so mobile home devices.
Okay. And I've heard about this 360L interface in cars. What's that about?
Oh, yes, 360L. That's actually pretty key for the in-car experience. It cleverly combines satellite and streaming right there in the dashboard.
So best of both worlds, live radio plus on-demand.
That's the idea. It makes it seamless. If the satellite signal fades, maybe it pulls from streaming, or you can access more on-demand stuff. It keeps them relevant inside the car, which is, their historical stronghold.
Makes sense. Okay, so that's the SiriusXM side. What's the other main part of the business?
That would be the Pandora and off-platform segment.
Ah, Pandora. I remember them.
Still a big part of it. That includes the ad-supported Pandora radio service, free version, plus their subscription tiers, Pandora Plus, Pandora Premium.
So ads and subscriptions there too.
Right. But what's really important strategically here is the off-platform bit. They don't just sell ads on Pandora.
Oh.
No, they sell advertising on other audio platforms too, and on widely distributed podcasts.
Yeah.
Big ones.
Okay.
Like they're the exclusive U.S. ad sales rep for SoundCloud.
Interesting. So they're becoming more of a broader audio advertising player.
Exactly. And they've been building the tech for it.
Right. You mentioned acquisitions. AdsWizz, Simplecast, Stitcher. How do those fit in?
Perfectly. AdsWizz is their engine for digital audio programmatic ads. Then they bought Simplecast in June 2020. That's a podcast management and analytics platform. Cost about $28 million.
Okay. Analytics are key.
Totally. And then Stitcher, October 2020. That was a much bigger deal, over $300 million. That really boosted their podcast creation, publishing, and advertising side.
So a clear strategy to dominate audio advertising, especially podcasts.
It seems like a major push, yeah. Monetizing content beyond just their satellite subscribers. It taps into that booming podcast market.
Let's talk reach, especially in cars. Those numbers sounded huge.
They are. As of December 2024, roughly 167 million vehicles driving around in the U.S. had SiriusXM radios installed.
Wow. 167 million.
Yeah, and that's up significantly from 135 million back in 2020.
How did they manage that kind of penetration?
Strong automaker partnerships. That's the key. They have deals with basically every major automaker.
Every single one.
Substantially all U.S. vehicles get a factory-installed satellite radio, and most of those come with a trial subscription.
That's an incredible built-in customer acquisition channel. Someone buys a car, boom, they're a SiriusXM trialist.
Precisely. It's powerful. But it's not free for SiriusXM.
Ah, right. What's the catch? Or the cost?
Well, they share revenue with some automakers, and they reimburse them for certain costs, hardware, engineering support, promotions.
So it's a cost of doing business to maintain that reach.
Definitely. And strategically, they updated their plan recently, December 2024. But they're focusing on strengthening that core subscription business, yes, but also really leveraging advertising across all platforms.
Efficiency, too.
Yeah, accelerating efficiency, focusing on margins, cash flow, and stockholder returns. Seems like a move to really optimize what they have.
Okay, let's shift to the people running the show. management and capital allocation. We've got Jennifer Witz as CEO since early 2021. Long history there.
Yes, since 2002, finance, marketing background, and Scott Greenstein, president and chief content officer. He's been there even longer, since 2004. Lots of media experience.
There was a CFO change recently, though.
That's right. Sean Sullivan was CFO from late 2020 to March 2023. Now it's Thomas Berry, who stepped up from being SVP and controller.
Okay. And you mentioned something about diversity and inclusion efforts.
Yes. Seems like a strong focus. They have a senior VP for it, reporting directly to the CEO.
Right.
They're doing specific things like recruiting from diverse communities, sponsoring conferences like Sistas in Sales, Afrotech. They have this Pathways program for HBCU grads, leadership development.
Yeah.
Sounds like a genuine commitment.
Good to know. Now, how does an outside analyst, like Morningstar, view how they handle the company's money? Capital allocation.
Morningstar rates their capital allocation as standard.
Standard. What does that mean exactly? Good, bad, average.
It's basically average. It means Morningstar sees their investment strategy, how they manage debt, dividends, buybacks. It's all reasonable. Not exceptionally good, but not poor either.
So, competent, but maybe not world-beating financial management.
That's a fair way to put it. It's the most common rating they give out. No major red flags, but maybe not creating a huge edge just through capital decisions alone.
Okay. And share buybacks. They've done a lot of that, haven't they?
Oh, yeah. Huge amounts. They had an old program, started way back in 2012, authorized $18 billion.
$18 billion.
Yep. By September 2024, they'd actually bought back $16.8 billion worth. That program ended because of a corporate restructuring, though.
Ah, okay. So did they stop buying back shares?
Nope. The board approved a new program immediately for the remaining $1.166 billion. No end date on that one. As of late 2024, they'd only used about $7 million of it, so plenty left. It shows a consistent focus on returning cash to shareholders.
Now, this corporate structure change you mentioned, that sounds important. Sirius XM used to be a controlled company. What was that about?
Right. This is a really big deal for investors. For years, Liberty Media owned a huge chunk of Sirius XM stock.
How much?
It rose to over 83% by the end of 2023. Because they owned so much, under NASDAQ rules, Sirius XM was considered a controlled company.
And what did that mean, practically speaking?
It meant Liberty Media basically called the shots. They could determine the outcome of shareholder votes, board elections. Their interests might not always perfectly align with smaller minority shareholders.
Okay, so potential conflicts of interest there. But that changed.
Dramatically.
Yeah.
In September 2024, there were some complex transactions. Essentially, Liberty Media did a split off of its Sirius XM holdings. And then Sirius XM merged into a new structure, which was then renamed Sirius XM Holdings Inc. again.
Okay, sounds complicated. What's the bottom line for investors?
The bottom line, the key takeaway for you listening, is that after all that maneuvering, Sirius XM is no longer a controlled company.
Ah. So Liberty Media doesn't have that overwhelming control anymore.
Exactly. Power is more dispersed. It means much greater protection and potentially more influence for all the other shareholders. It's a major positive shift in corporate governance.
That is significant. More transparency, perhaps more accountability to all shareholders. Okay, governance aside, what about debt? How's the balance sheet looking?
Well, debt has gone up. As of the end of 2024, total debt was around $10.4 billion.
That's up from $9.2 billion the year before. Is that a concern?
It's a big number, for sure. But the key is how they talk about managing it. They really focus on free cash flow.
How do they define that?
Cash from operations minus capital spending and other investments. They use that free cash flow for everything. Acquiring subscribers, paying down debt, making acquisitions, and, returning capital to stockholders, like with the buybacks.
So they're generating the cash to handle the debt.
That's the plan. They also have a debt covenant, basically a rule from their lenders that their total leverage ratio can't exceed 5.0 to 1.0. So there are guardrails in place. Suggests discipline.
Okay, discipline, but carrying a fair bit of debt. Now let's talk competition. It's got to be fierce in the audio world.
Absolutely intense. They face serious competition for listeners and advertisers on both the SiriusXM side and the Pandora platform side.
Who are the main rivals? Still traditional radio?
Traditional AM/FM is definitely still a competitor. It's free. It often has local news, local sports. That makes some people hesitant to pay for a subscription like SiriusXM.
That free factor is tough to beat. But who does Morningstar see as the biggest threat today?
Streaming music providers. That's what Morningstar identifies as the primary competition. Think Spotify, Apple Music, YouTube Music.
Why are they seen as such a big threat?
Well, they rely on internet connectivity, which is pretty much ubiquitous now. And Morningstar believes they offer a better value proposition for most consumers. Often cheaper, sometimes free with ads.
So it's a direct challenge to Sirius XM's model, especially the satellite part.
Exactly. It's a different way of getting audio, often seen as more flexible or affordable.
So it's like they're in a tech race, almost. Sirius XM with its satellites and 360L versus streamers beaming through phones. How is Sirius XM fighting back?
They're definitely not standing still.
Yeah.
They're doing things like offering app-only subscriptions, trying to make it easier to use in cars, even without the built-in radio.
More options.
Yeah, more ad-supported plans, too. They're investing in their ad tech, pushing those new 360L radios to that seamless experience.
And podcasts. You mentioned that earlier.
Big focus there. Building an exclusive podcast library just for SiriusXM subscribers. And putting more investment into podcasting generally, trying to make money from that content on other platforms too through advertising.
So adapting, trying to compete on multiple fronts.
They have to. It's about staying relevant as listening habits change.
This brings us to a really crucial concept for investors. The economic moat, that idea of a sustainable competitive advantage. What does Morningstar say about SiriusXM's moat?
Okay, this is stark. According to Morningstar's July 2025 report, SiriusXM has none.
None. Zero moat. That seems harsh given their brand name. All those cars.
It is a stark assessment. Morningstar's reasoning is that the original advantage satellite delivery in cars just isn't that unique anymore.
Because streaming can do it too.
Essentially, yes. With streaming as the main competition and offering, in Morningstar's view, better value, they just don't see a durable edge for SiriusXM.
So no moat means they have to compete purely on
price, basically, and content. They have to keep paying for compelling content rights to attract and keep subscribers because they don't have a structural advantage protecting them.
What about their brands? SiriusXM, Pandora, even things like Music Genome Project. Isn't that a moat source?
They acknowledge the brands are recognized trademarks, but Morningstar doesn't see that translating into a sustained economic moat. Not strong enough to really fend off competitors long term.
Okay. What about switching costs? Is it a pain for people to cancel, making them stick around?
Well, it's interesting you ask. The sources do mention legal issues around their cancellation practices in 2023 and 2024. Class action lawsuits and investigations.
So maybe it is hard to cancel.
It might be, or might have been perceived as such. But crucially, the reports don't frame this as a protective economic moat. It's discussed more as a legal risk or operational headache, not a sustainable competitive advantage.
Got it. Not a moat source. Any other potential moat sources? Network effects, cost advantages, efficient scale.
The sources just don't point to those for SiriusXM, especially given the competition. I mean, yes, running a satellite network is incredibly expensive, capital intensive. That's a barrier to entry for someone new wanting to launch satellites.
Right.
But it's not really framed as an efficient scale moat against existing competitors like streamers who have very different, often lower infrastructure costs per user.
So Morningstar's view is pretty clear. No moat. Okay. With that competitive picture, how is the company actually growing? What does the top line look like?
It's definitely a mixed bag. And this is where things get quite nuanced for investors.
Okay.
Overall, total consolidated revenue actually dipped slightly in 2023, down 1% to $8.95 billion from $9 billion in 2022.
A decrease, not ideal.
No. And Morningstar's early report noted a quarter where revenue fell over 4% year over year. They called it the weakest quarter in 4 years. Subscription revenue specifically was down 5% in that snapshot.
Ouch. That subscription number is key. What about the different parts of the business? SiriusXM versus Pandora?
Okay, so the core SiriusXM subscriber revenue, that actually grew 4% in 2021 and 5% in 2022. But then it flattened out, decreased just under 1% in 2023.
So, stalling growth there.
Seems like it. The company says they expect future increases from price hikes and growing the self-pay base, but that's an expectation, right?
Right. What about Pandora subscriptions?
That's weaker. Modest increases in 2021, then flat in 22 and 23. And significantly, the company itself expects Pandora's subscriber revenue to decrease because the user base is shrinking.
Okay, so subscriber revenue looks challenged, especially on the Pandora side. Any bright spots?
Yes. Advertising revenue, that's the counter-narrative.
Okay. How's that doing?
Pandora's ad revenue jumped 30% back in 2021. And more recently, Morningstar highlighted podcasts as a big driver. Ad revenue from podcasts was up 16% year over year in a recent quarter they analyzed.
So the pivot to advertising, especially podcasting, is actually showing results.
It seems to be. It suggests they're finding new ways to make money, even if the traditional subscription model is facing headwinds. That shift is crucial to watch.
Okay, so a real mix. Slowing subscriptions, Pandora declining, but ad revenue, particularly from podcasts, growing. How are they doing overall at keeping the users they have and getting new ones?
Well, the word they use is uncertain. Attracting and retaining subscribers is a challenge.
Why?
They expect higher conversions from trials, yes, but they admit issues with price-sensitive customers, especially people buying used cars who might not want to pay up.
And younger listeners.
Yeah, they mentioned a potential increase in millennial generation customers who are just more used to free ad-supported stuff. The churn rate, the percentage of people leaving each month, has been pretty steady, around 1.5% to 1.6%.
Okay, so steady churn, but challenges attracting certain groups. Are they investing to try and fix this?
Yes, they expect higher costs in R&D engineering, design as they build out infrastructure and new products, and also higher programming and content costs for new shows and channels.
Necessary spending for growth, but it hits the bottom line short term.
Exactly. Investments now for potential payoff later.
All right, let's tackle the big one, risk and uncertainty. Morningstar gives them a specific rating here.
They do. And it's very high uncertainty.
Very high. What does that signal to an investor?
It signals a really wide range of possible future outcomes for the company's value. Lots of variables, lots of things that could push the stock price significantly up or down. It makes forecasting difficult.
Okay, so lots of uncertainty. Let's break down the risks. Operationally, what are the absolute biggest worries if you had to pick, say, the top 2 or 3?
Good question. For me, operationally, number one has to be competition.
Just the sheer intensity from streamers.
Yes. It directly hits their ability to get and keep subscribers, especially paid ones. You see it in Pandora's declining active users and listening hours. It's relentless.
Okay, competition's number 1. What else?
Number 2, I'd say, is their auto industry dependence. Their fate is tied so closely to new car sales and leases.
So if car sales slump,
It hurts them directly. Think semiconductor shortages, supply chain problems like we saw, war impacting components. Anything hitting car production hits Sirius XM's pipeline of new trial subscribers.
right, dependence risk. A third one?
I'd point to the satellite risks. This is unique to them. Their whole Sirius XM service depends on those satellites working perfectly.
And they don't always.
Nope. They can get damaged. Components fail. They had SXM-7 fail during testing in orbit back in 2021, declared a total loss. A failure like that could seriously degrade or even knock out service. It's a constant, high-stakes operational risk requiring massive investment.
Wow. Okay, competition, auto dependence, satellite failure, those are big operational risks. What about legal and regulatory stuff?
Plenty there, too. They need FCC licenses to operate, and those need renewal, not guaranteed.
Right.
Copyright royalties are a constant battleground. Ongoing proceedings with the Copyright Royalty Board about how much they pay artists and labels, rates can change, impacting costs significantly.
And those cancellation practice lawsuits you mentioned.
Yep, consumer protection laws. Investigations into marketing, pricing, cancellations. Compliance takes resources, and they face class actions. Plus, general litigation, risk patent infringement for radios, things like that.
Anything else on the regulatory front? ESG.
Yes, environmental, social, governance. Increasing focus from investors and stakeholders. They need to report on it, invest in initiatives. Failure to meet expectations could mean legal issues, higher costs, or damage to their reputation. Cybersecurity is part of this too, managing data risks.
Okay. Finally, financial and corporate governance risks. Beyond the debt level itself.
Well, the big one stemming from that Liberty Media transaction is the tax indemnity.
Explain that again.
Post-split off, SiriusXM basically promised Liberty Media they'd cover the tax bill if the whole transaction somehow gets deemed taxable by the IRS down the road.
And that could be huge.
Potentially massive. It's an unlimited indemnity. It could also restrict SiriusXM from doing certain deals in the future if those deals risk triggering the tax liability. It's a significant financial overhang.
Wow, an unlimited tax indemnity. That is quite the footnote on the balance sheet. Okay, so let's try to pull this all together for the listener trying to make an investment decision.
Okay. To recap, Sirius XM Holdings, it's this unique mix, right? Satellite radio, streaming via Pandora, big reach in cars, definitely investing in podcasting and ad tech.
Right, and management seems active acquisitions, efficiency drives, that a big governance change, getting rid of the controlled status.
But, and it's a big but,
Here it comes.
intense competition from streamers. A very mixed revenue picture growth in ads, yes, but questions around subscribers, especially Pandora shrinking. And, crucially, Morningstar sees no economic moat.
Plus that very high uncertainty rating hanging over everything.
Exactly. It makes predicting the future really tough.
Okay, but despite all that, what does Morningstar think it's actually worth? Do they give a price target?
They do. Their fair value estimate, or FVE, that's their calculation of intrinsic worth, was $30 USD back in October 2024.
$30. And where's the stock price when they last reported?
The last closing price mentioned in the July 2025 report was $22.93 USD.
So trading well below Morningstar's fair value estimate.
Yep, that gives it a price to fair value estimate ratio of 0.76, suggesting it's undervalued, according to Morningstar's calculations at least.
Okay, undervalued, but no moat and very high uncertainty. That's the puzzle for investors.
Precisely.
So what does this really boil down to for you, the listener, thinking about your portfolio, given that lack of a clear moat, the high uncertainty? The big question is this: how effectively can Sirius XM really leverage that huge car presence, leverage the growing podcast network? Can they innovate enough to capture value in this super competitive audio world?
Right. Can they do it without just cutting prices or constantly paying more and more for expensive content rights? What does that path look like?
And what does that ultimately mean for its long-term investment potential? It's definitely a fascinating challenge to weigh up as you consider its future.